Now I want you to check out this daily chart of the dollar index on its own. Right now, it's trading right above a major floor of support at 93. Meanwhile, the relative strength index, or RSI, and the Williams percentage R oscillator, and those are both key important momentum indicators, both show that the dollar's oversold. Okay, so you got the dollar oversold, really oversold, meaning it's come down too far too fast. So you can argue it's due for a bounce. That's typically what happens. But Garner points out that 93 is still pretty high on an historical basis. If the dollar index holds above 93, she says gold's finished. If it breaks down below that level, she thinks the next stop could be 2018 lows of 88. Gold can have another leg higher, maybe a big one. I know that's problematic then because it says it could be big either way. But so let's keep delving into this. I want to zoom out and look at the monthly chart of gold. The last time the precious metal exploded higher like this in July of 2011, the rally went nearly parabolic. Then we got that blow off top in August as the debt ceiling crisis was resolved. If that pattern holds, Garner says the gold market's likely in the process of setting up a reversal. Although, again, gold won't peak until the dollar bottoms. That's the takeaway of this. Still, it's pretty overbought. The relative strength index on the monthly chart is approaching 83, which is very high. The Williams percentage R oscillators almost maxed out at 99. I mean, that's just way too high. Garner points out that these levels are totally unsustainable over the long run, just totally. But in the short run, they can convert even the most bearish of bears. For example, if you sold gold when the RSI went above 80 in 2011, and you can see this right here, when RSI went above 80, well, you missed a $300 gain before the peak, all right? And that's, you wanted to make that, get that money. And it's not just 2011. Garner's noticed that the precious metal tends to rally $300 to $400 right before prices implode. Wow. Problem is, she's not sure exactly where we are in the pattern. If it looks like the peak in 2008, then gold could rally to 1980 right here, okay, or 2000 before it runs out of steam. Up just 1 or 2% from here, not worth being involved. But if this is a 2011 situation, Garner could see gold soaring to 2,250 or even 2,300 before it peaks. That's a fabulous 15% to 18% move. At the moment, she thinks the former situation is more likely, but if we get one more massive run, you need to understand that it'll be likely to be a quick probe higher that doesn't last very long. When a gold boom goes bust, it gets really ugly. Once the meltdown starts, Garner thinks we can trade down to 1525 or 1450. I mean, you may not mind that, because if you like gold like I do, you may just say, okay, that's the price of entry, maybe down to 1300. If we go all the way down to the uptrend support, 1,300 would be obviously painful, but I believe the 10% of your assets should be in gold. One more thing. The August gold options expired today, and speculators will be forced out of the August gold futures by the end of the week. Garner points out that these expirations can produce some wild action, often a major extension of the previous trend followed by a big reversal. And this thing about oil, right? Remember when oil went to minus 37? That'd be a rapid rally and then a sharp decline. So I need you to watch out. And I've been really bullish on gold, so I even myself am tempering my feeling.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.